Hi, I'm Pattu from freefincal. Today, let's talk about the performance of thematic mutual funds, and it's just terrible to see that out of 87 thematic mutual funds, only 9 of them have managed to consistently outperform the Nifty 100. Obviously, the investment mandate of those thematic fund is not to beat the Nifty 100, but from an investor's point of view, the thematic mutual fund has got a much higher expense ratio than an index fund. Sometimes the expense ratio can be even higher than a diversified mutual fund. And if after paying such a exorbitant expense ratio, such a fund is not even able to beat a simple Nifty or Sensex index fund, then it is not for retail investors who will make the mistake of systematically investing in these funds, assuming it will give you returns. Of course, I'm not saying don't invest in thematic mutual funds. Thematic mutual funds or sectoral mutual funds are only for people who can do at least one of these two things. One, they should have some kind of understanding about the sector, and they are too lazy to pick stocks in that sector that they want a basket of funds in that sector. Of course, those who know the sector are better off picking individual stocks in that sector. That's always better, at least from an expense perspective, if not from a return perspective. The second point is that in thematic mutual funds, people should be ready to make tactical exits and entry, and you can't simply start investing via SIP, and that will, as we are seeing now, will not always work. So, and these, I'm not, the fund lists mentioned here are, they're not investment recommendations, so please don't invest in it. I'm just trying to point out that that even though there are so many funds, very few of them are able to beat the Nifty 100. So what we're going to do is to consider every possible 3-year, 4-year and 5-year investment window between the 1st of January 2013 and October 6th, 2021. We will define a return outperformance consistency as in the following way. That is, if suppose I have 100 3-year return data points, and if a fund beats the index, that is Nifty 100, 65 out of those 100 times, then the return outperformance consistency is 65%. Similarly, we will also define a downside capture consistency. So we have to find out, so for example, for the same 3-year period, we look at the monthly returns, and for those monthly returns, when the index return was negative, we find out whether the fund return was more negative, that is, the fund fell more than the index, or it fell less than the index, and that will help us calculate what is known as the downside capture ratio. And the downside capture ratio should be less than 100. That is, if the index has lost 100%, the fund should lose less than 100%. So the downside capture ratio should be less than 100, and we find out how often the downside capture ratio is less than 100, and that gives you the downside capture or the downside protection consistency. So we have these two kinds of measures. These are part of my the monthly mutual fund screeners that I published at freefincal. And so what we have done is, first we will define a consistent performer as that which has outperformed the Nifty 100 in terms of return at least 70% of the time. That is, the rolling return performance consistency should be 70% or more. Then we shall look at the downside protection. So the 9 funds which have consistently outperformed the Nifty 100, please don't treat these as investment recommendations and start investing systematically. That will never work, at least definitely not with sectoral funds, because sectoral performance can sometimes it can be well above Nifty 100, sometimes it can be well below that, and so on. So these are Mirae Asset Great Consumer Fund, Canara Robeco Consumer Trends, Birla Gen Next Fund, the Invesco Financial Services Fund, ICICI Banking Fund, SBI PSU Fund, SBI Banking and Financial Services, Tata Digital Fund, and the Nippon India US Equity Opportunity. So this is the only fund which is an international fund. I think the rest of them, I don't, maybe some of them have a little bit of, I'm not sure whether Mirae Asset Consumer has got a little bit of foreign stock exposure. I have to check that. So out of those 9, if you in addition demand a downside protection consistency of more than 70%, the list even reduces further to 6, and these are the 6 funds. So this is a quite a terrible result if you look at it. I mean, it just tells you that retail investors should not blindly start SIPs in these thematic and sectoral funds, because you never know what the performance with respect to a simple index, that is a market capitalization weighted index, is going to be. And it is, I mean, if only 9 of them are going to outperform out of 87, then the chances of you finding a good fund that will work in future, that is a fund which will be labeled as good in future, is practically non-existent. So please avoid.